This podcast is sponsored by Pogo, Property Operations on the Go. Facility managers know how challenging it can be to keep everything running smoothly. That's why Pogo was created, a white-labeled software solution designed by property managers for property managers. Pogo is your ultimate all-in-one platform for managing multiple assets. With Pogo, you communicate with your tenants, manage maintenance requests, control property access, manage bookable spaces, and much more. Plus, with advanced analytics, Pogo empowers you to optimize your operations anytime, anywhere. The best part? Pogo is completely customizable to fit your brand and business. Simplify your operations, enhance tenant satisfaction, and save money with Pogo. Ready to make the switch? Visit gopogo.us to schedule your demo today. Pogo, one system, multiple solutions at your fingertips. Mark Befford here with Real Opportunity, here with Tim McKay, Vice Chair of the Central Region for Newmark Companies. Glad to have you here, Tim. You are the leading multi-housing specialist from a brokerage standpoint in the region. And we'll get into that here in a little bit. But before I want to learn a little bit about you in the past.
Sure.
And, we met probably, 10, 12, 14 years ago.
Yeah.
And a great relationship since. But tell me, what did you do before you got into multi-housing?
Yeah. Well, I'm sure like most people or a lot of people that get in this business, it's definitely a winding road, right? I mean, I know yours is as well. And I graduated from Oklahoma State with a degree in education and was a...
By the way, my daughter goes to Oklahoma State. She's on the equestrian program.
Equestrian team,
yeah. She's a freshman, yeah.
Yeah, and one of the best programs in the country,
by
the way.
Yeah, they're actually
really
going to compete
elite.
for a national championship this year.
Yeah. Got my degree in education, and I was a science teacher and a basketball coach for 5 years. 3 years at Kingfisher High School and 2 years at Seminole, and started having kids, and wife was staying at home with the kids, and I was making $18,000 a year, and I thought, man, something's got to be different. So really just took a leap of faith. I remember it was one of the first times in my life where I really was committed to being in the Word, praying, really seeking something other than just what I wanted. Really, trying to find out what do I need to be doing. We've all asked that question, right? What's my purpose? And really just took a blind leap of faith, and I wound up going to work at Oklahoma State in the alumni department, and then eventually went to work in the athletic department. And some of the best years, I mean, it was a phenomenal job. Got to know everybody in the state, that was associated with Oklahoma State, and did a lot of cool traveling with the sports teams and that kind of thing. But the kids were getting older, and I literally was gone nearly every night with OSU stuff, right? So you're missing all the kids stuff. And
sure.
I'm getting to a point here, I promise you.
No, you're great. Those are great.
One of the guys that was an All-American golfer at Oklahoma State named Roger Brown owned several banks, and he had just bought a credit union that had failed, or savings and loan rather, that had failed in Stillwater. And he called me. One of my buddies worked for his bank in Ponca City and said, hey, I'm really interested in visiting with you about coming to work at the bank. And I said, well, Roger, two things. One, I'd just been offered a job to be the head fundraiser for Navigators, which is a Christian ministry in Colorado Springs nationally that would have required to move to Colorado Springs. It was a pretty deliberation process for me that I wound up turning down. And I said, Roger, I've been in the bank like 3 times my whole life. I said, are you sure are you sure this is what you want me to do? And we met for lunch, and I remember him saying, really the key thing is we need somebody that knows the people in town. And I did know that, right? And I said, well, man, I'm just not sure. I love my job. I don't know. I was probably making $30,000 a year, $32,000 a year, something like that at the time. And I remember Roger sitting across from the table from me at Mexico Joe's. And he said, Tim, if you'll come to work for us, I'll pay you $75,000 a year.
Wow, what year was this?
This would have been 1996.
75. That was a lot of money.
It was.
Yes,
yeah, particularly if you were making 32.
Sure.
Right?
Yeah.
And it wasn't one of those deals I need to talk to my wife. I need to pray about it. It was like, I'll be at the bank Monday. So that's how I got into the banking world, which, as you know, in real estate, understanding the finance side of it is just such a critical piece of the puzzle, right?
Yeah.
And I really just commercial real estate was so much easier lending side than like operating businesses where you're managing inventory and all that. So commercial real estate is kind of just where I really started focusing, and I did a lot of that.
At the bank.
At the bank, yes.
Yeah.
And so I wound up actually loaning money on several apartment buildings. Met a couple of brokers, and the long story short, I just finally decided, hey, I'm going to take a chance on me and go see if I can do it. I was going through a personal life change at the time. I was in the middle of a divorce, and just
Right.
it just was the time.
Yeah.
You know,
So let's take a quick step back. What's it like being a high school football coach?
basketball.
I'm
and
sorry,
golf.
basketball coach.
It was awesome. It is crazy when I get a phone call today and somebody says, "Hey, coach, how you doing?"
Oh wow.
That really
That's
feels
chilling.
cool.
Yeah.
It is chilling.
That means you had an impact on that kid's life.
Absolutely. And there's a dozen of those kids I'm really close with today. Matter of fact, there's a group of them that I meet with lunch once a month.
Wow.
I have to share about some of them now that you've asked, but one of Todd Brown, who started 180 Medical.
Oh yeah, here locally.
Yeah. Todd was a really good high school basketball player. It was involved in an unfortunate motorcycle accident, was paralyzed, but he started 180 Medical and sold it for a meaningful amount of money, but he's still super involved in the community, has great kids. He serves on the FCA board with me. Rod Bowie, Kyle Rickner is a doctor here in Oklahoma City now. Actually started PHP, Primary Health Partners,
Yeah.
the
Oh,
kind of
yeah.
one-on-one
You bet,
service.
you bet.
A kid named Delbert Terrell, who's from Kingfisher and was in the Navy and actually just retired as the highest ranking non-commissioned officer in the history of the Navy.
Wow.
I mean, he was running the base in Rota, Spain.
Yeah.
So anyway, some
No,
great memories. That's just super cool.
That what strikes me there is we go through life, we're just working, but you and I are pretty close to the same age, and it's about how we've impacted people's lives, and you never know sometimes how you're doing it until an instance like that, a guy calls you and says, "Hey, coach." That's really, really cool.
Isn't it cool?
It's so cool.
And
So
you know, you and I've actually had some of these conversations, at the age that we're at, and we're so blessed to be in the position that we're in, but you do start thinking about legacy stuff, right? And not about you.
No, it's about others.
What do you leave, right?
How are you impacting others?
Yeah. And what do you leave for others? And I don't mean like money, but just like Robinson Park.
Yeah.
The Newmark Central States
that's right.
apartment team, these kind of things for these young guys and young gals to just keep getting better and better.
Okay, so you're at the bank.
Yep.
And you met some brokers.
Yeah.
So how'd you go from the bank into
broker.
into Newmark's national team?
Yeah. So the first opportunity was with a local group called Apartment. God, what were we called? Apartment brokerage team, I believe. Mike Buell.
Oh, Mike Buell, yeah.
Was in Norman. Was one of my.
What's Mike doing these days?
He's retired now.
Is he
What
really?
an
Okay.
absolute jewel of a
Great
guy.
Great guy.
Yeah, and a
Great
really
guy.
good broker. He really was.
Yeah.
And we formed that team, and we tell people we sold our company to Bracadia. It was with Hendricks and Partners. We went to Hendricks and Partners, and we sold our company to Bracadia. I think we almost sold it for enough to pay off the debt that we owed from building everything that we had done, right? But we joined Bracadia. Shortly thereafter, the ARA team was beginning to be developed, and it was kind of in this region. Brian O'Boyle down in Dallas was heading that up. And Brian had got Brandon Lamb, who's one of my business partners that lives in Tulsa, to come on board and start the ARA team in Oklahoma. That would have been around probably 2010, would be my guess. And shortly thereafter, I joined ARA as well. So Brandon and I kind of started ARA in that 2010, 2011 range. And of course, obviously that's gone into Newmark, but the significant things that happened there just by God's providence and some wonderful things. That's when we really got connected with you and Andy and David and Justin, right?
Because I remember I got a call.
Yes.
So ARA got bought by Newmark.
Yes.
And I got a call from Newmark saying, "We made a major acquisition. You can no longer do apartment deals." I go, "Well, that's a problem. we better meet."
Yes.
And that I remember up on the 7th floor of City Place. First time I met you and Brandon. By the way, Brandon's awesome. What a salt of the other guy.
Yeah.
I remember we met and hashed out a deal, and here we are today. So
yeah, I know. And because I didn't know you or Andy or David or Justin, any of you at the time. Brandon had, I think, connected with maybe you and Andy at some some event. I don't remember exactly what it was. And so as Brandon and I were talking through that, we were like, well, gosh, number one, we know they're really good at what they do. They're probably our biggest competition, but we also don't want to ruin anybody's life either, right? There has to be a way for grown adults to sit around a table and figure this out where it's good for everybody. And I think we did it in like 30 minutes. I mean,
we did. It was pretty quick. And I want the audience to understand, it was not me, because I have nothing to do with the apartment world. That's what you guys do. So it really was Andy and David and Justin at the time were the three.
Yes.
That were you and Brandon really had to come to a meeting of minds. How can we work together? And you guys are still together. That was 15 years ago.
Hey, how unusual is that in a real estate world?
It is. Well, first off, it speaks to the character of you and Brandon and everyone else.
I agree.
And because it not only are you the leader in the region, but you've also stuck together, and that's hard.
It is hard.
Yeah.
And that doesn't mean we haven't had some tough discussions or haven't had challenges, right? But I think that's been one of the things that's been great. And even with you, right? I mean, there's always been challenges that we face. But I think the thing that's been great about our partnership and then our partnership with Robinson Park is we can have those discussions because we know we deeply care about the people around the table.
Right.
We want what's best for everybody involved.
Yeah, that's right.
And so we can have really transparent conversations because nobody's trying to win.
Yeah, that's right.
Right?
Yeah, that's right. So let's wrap up talking about your journey with, so you guys now, so you transact probably 80+% of the deals in Oklahoma. And then you guys moved to Arkansas. Then you did a little bit in New Mexico.
Wichita.
Yeah. And then Newmark had an opening for how many additional states?
So it's Kansas, Missouri, Nebraska, Iowa, and we've also picked up Southern Illinois.
So you've got 5 additional markets that Newmark said, hey, if you will do X, Y, and Z, we'll give you these markets. And so now you're in 9 or 10 different markets at this point.
Yeah, markets for sure. States, there's a total of 7 that we're covering.
7 states,
yeah.
Oh, yeah. But Oklahoma City, you have Tulsa and Oklahoma City.
So really the primary markets are Oklahoma City, Tulsa, Northwest Arkansas, Wichita, Kansas City, St. Louis, Omaha, and Des Moines. Right. I mean, those are awesome. The primary ones. Yeah. It was a obviously a phenomenal opportunity, and we've been really, really blessed. As you mentioned, in Oklahoma and Arkansas, we've had 75 to 80% market share for many years, and that's highly unusual in our world. We've learning very quickly that Kansas City and St. Louis are much more competitive in that. And we
when you say competitive, there's a lot more talent there that you compete with from a brokerage standpoint.
Yes.
Okay, gotcha. Yeah.
Yes. And Kansas City and St. Louis are both much bigger. I mean, Kansas City's MSA's $2.5 million. St. Louis is $2 million. Oklahoma City and Tulsa combined are $2.5 million.
Yeah.
But we brought some good guys and gals on to partner up with there. We brought one of the leading brokerage firms from St. Louis has joined us in Newmark, and then we brought a guy that was one of the leading brokers in Kansas City. It's certainly taken a lot more of my time than I ever thought or imagined it would.
Yeah, no, I hear you.
And I mean, just from running a brokerage shop for me, I'm running a much smaller team. I think we have 12 brokers altogether, and it's all consuming with stuff that doesn't include executing deals.
Yeah.
Right?
No,
that really has surprised me.
No, it's hard. It's hard. Well, good luck with that.
Thank you.
So let's dig into the multi-housing world.
Yeah.
And some people call it apartments, some people call it multi-housing. It's all the same thing, correct?
Yes. Yeah.
So you primarily concentrate on units, of 100 units and greater?
Yes. So personally, what I have pretty much done is kind of what we would call Class A space in our markets, right? So as a rule, kind of 2,000 and newer. And Justin was kind of doing the older stuff. As we've kind of grown, Justin has transitioned into doing more of that. And then we do have, Ted Prince and my son Ben McKay that work with us. Ben runs the Northwest Arkansas market, but Ted focuses a lot more on what we call a private client deal, which for us now is kind of a $5 or $10 million deal or under. So it can be 50 units, 100 units. You know what I'm saying? It kind of depends on where it is. And it's really it's an attractive space to be in, and it's really good. It's just the buyer profile is so different than the buyer I'm looking for for a newer property.
So let's talk about your logic, not about a particular deal, but your logic on how you underwrite things. I mean, one thing I really appreciated you is you're like me. You want to know every detail about the market and what's driving the market and how's it ultimately going to affect it. So what are some of the things that you look at on a day-to-day basis as you evaluate the market?
Great question. Let me go back 1 second on that, because when we first got started in this, in 2010 range and after, well, we spent a lot of time having to sell Oklahoma City to investors. So man, it was super critical that we knew everything about the market. So it was a great training tool for us, because so many people that we were trying to sell a property to didn't know about Oklahoma City, which is stunning to us in this room, right? But they really didn't know, as you well know, right?
Yeah, but there was a point in time, there were folks that came from out of the market, whether it's California, East or West Coast, and they were trying to buy things here because they couldn't fathom the price per unit, how cheap it was, and they just felt like they were just buying by the pound. Is that right?
Absolutely, and it caused some stress in the market in the 2005 to 2010 range. It was a lot of California 1031 money. I mean, some maybe smaller operations or even mom and pops that were selling a duplex and converting the equity into a 50-unit apartment complex in Oklahoma City. And they weren't great operators.
So when you say stress, how would that cause stress in the market?
They probably overpaid because they were 1031 and under the pressure to avoid taxes, and sometimes your decisions you make in that aren't always the best. Right. But the biggest reason was they weren't great operators.
Right. Yeah.
So they came here and
so they were trying to operate from afar. Yes. They wouldn't hire local management. Oh my God.
Or even if they did, they weren't asset managing it correctly, which, as you well know, with the stuff that you own in Indianapolis or whatever.
It's important.
Even if you have a really good local management team, if you're not overseeing it at the asset management level, it's going to really get crushed.
Yeah.
So we spent a ton of time, particularly back then, on understanding oil and gas, because the national perception with Oklahoma City was we're an oil and gas city. And, we spent, we really understood that, hey, it's, 3% of our jobs, 6% of our numbers, it's this percent of our GDP, all those kinds of things, right? Which Oklahoma City has obviously changed dramatically in the last 10 or 15 years. But the things that we look at, the things that are key from a multifamily perspective is, it's all about people, right? It's job growth and population growth. That's really the ultimate things. And Oklahoma City's obviously had great unemployment rate. We've benefited greatly from the net migration over the last 3 years since COVID, particularly. State of Oklahoma is one of the top 10 states in the country for net migration. So for us, it really is just about people. And then the other thing that is a great selling point for Oklahoma City is its low cost of living. As you know, Oklahoma City is the second lowest city for cost of living in the country for cities of 1 million and below, only above or below Memphis. That is obviously a huge draw for multifamily as well, just because of the affordability. And then particularly in the last 3 or 4 years, we've seen people from the coast that want to invest in what they would consider to be safer markets along this whole I-35 corridor, which would include obviously all of Texas, but up into Tulsa, Kansas City, up into those areas for a lot of reasons. Some of them are just some core values, but I think also just business-friendly states is probably the best way to put it, in doing that.
So some of the fundamentals, one is just your monthly rent. And you guys look at it on a month per square foot.
We usually talk that language, which is, hey, on new construction, rents are $1.60 a foot, right? Downtown, it's $2 a foot. Yeah.
Right. So 1,000 square foot unit at $2 a foot would be $2,000 a month, right?
That's right. Exactly.
So what happened during COVID from 2019 to the end of 2025? What happened to rents at that point, given all the inflation we saw?
Yeah, it's crazy. So Oklahoma City's historical rent growth has been about 2.5% to 3% per year. Okay. from 2020, 21, and 22, we saw double-digit rent growth in Oklahoma City for 3 consecutive years.
Wow.
So I don't remember the exact numbers, but all 3 years north of 10%, which when you look at historical rent increases of 2.5 to 3, is obviously, very, very meaningful. That number has flattened back down. Now we're back to underwriting 2.5 to 3%, which is much better than some markets like Austin and Dallas who have been overbuilt, who literally have had like negative 8% rent growth.
So those poor saps who bought based upon a 10% rent growth probably had some challenges, maybe, but I got one other point here. But at that time, interest rates were really low. So if they were able to lock into long-term low interest rates, they shielded themselves a little bit. But that poor sap who relied on the 10%, let's just call it 8, 9, 10%, and had floating rate debt, and they got caught in that cycle, what's happened to those guys?
That is where the real challenge is. Now, fortunately, we don't have a lot of it in our markets.
Okay.
But to your point, particularly on 80s type product in Oklahoma City, we had a lot of buyers that were buying in, markets where interest rates were 3, 3.5%, 4%. Cap rates were in those relative ranges, but they were putting floating debt on it. And as that debt began to mature, those rate caps expired. Well, the options were not really good for them because the majority of those deals that were bought in 21 and 22 at that cap rate with floating debt, when that debt matured, the property wasn't worth as much as it was when they bought it. So they're upside down. And again, we've had a few of those in Oklahoma City, but it's been mostly in our older inventory and in Tulsa. It's very painful for the people involved, but it hasn't had a huge impact on our market because it was a smaller number. Now, again, the people that are involved, it was, it's incredibly difficult. But yes, but to your other point, the people that bought that stuff in 21 and 22 and put 10-year fixed rate debt on it,
they're doing okay.
They've managed the process, even though, as you well know, insurances has gone up significantly, although it's coming back down a little bit, right?
No, it is. But so I was going to ask you on the insurance side, how rapid did the expense side go up?
As rapid as the rent increase, and particularly on the payroll and insurance side. Okay, so that's where we saw the biggest jump.
What about utilities? Did that go up?
I don't think it was as meaningful as, certainly not as insurance. When we were underwriting as a rule of thumb, $300-400 a unit, and it got up to over $1,000 a unit. And I think we're back down to about $650 a door is typically what we underwrite. So it's lower, but it was really tough for a while.
In Oklahoma, why has it come down? I mean, why has it come down?
That's I think what I've been told from the insurance guys that we talked to is for a while, some of the major carriers kind of stepped away because of the concerns. We've always been a little higher on the insurance just because of wind and hail and all that stuff. We had some pretty major events, and was that 11 and 12, I think, where we had those big hailstorms?
Ice storms.
And that combination, things just began to jump. I think we haven't had as many major storms, that have had as much impact. We had the big ice storm in 21.
I remember, something like that.
Yeah, where we lost all the trees and we had a bunch of apartments that actually had a bunch of freezing and stuff like that. But as far as major wind, hail events, we've been fortunate hadn't had many. I think that's the biggest impact.
In our office portfolio, we were at 17 cents a square foot. We got as high as 42. Can you imagine that? Over double the insurance.
And with the leverage that you have to do that, right?
Yeah.
Think about a one-off owner.
I mean, we have close to a $2 billion policy.
Yeah.
Yeah. If you're a one-off with a big roof, you're in trouble. Yeah.
So I will add one thing to that because I think it is a good point. As we brought so many new buyers to the market that are major players, I'll give you an example. Dean Widener Apartment Homes. We've sold them a lot of apartments. Dean owns about 70,000 units nationwide.
Wow.
So when he puts on an insurance deal, he'll blend it across the entire thing. So he can be more aggressive in Oklahoma. And not just him, there's others, right?
Sure.
To your point.
He's got buying power
exactly.
on that insurance. Yeah. And he's got not only geographic challenge. And I think in Oklahoma, and this is, I'm sure Mike Morgan or David Payne are going to call me on this.
Yeah.
I just hope that they're listening. But I think the weather pattern has changed a little bit. It's moved a little bit north and a little bit east.
I agree 100%.
So I do think we're going to have less of big challenges.
And I want to say, I'm not a meteorologist
I'm not either.
or scientist, but as I watch the weather, it sure feels like it, right?
It sure feels like it. Okay, so let's get into construction costs, because what we see in the office sector, obviously we've had pressure on occupancies because of work from home. Those are actually starting to come back. We saw rising operating costs. We saw rising debt costs if you're part of that group that stayed on a floating rate. But then we also saw rising cost of, in our world, it's TIs and actually capital costs. Those, we saw 30-40% increases in those. What's happening in the multi-housing sector?
Yeah, it's been phenomenal.
Mm-hmm.
You know, it brings back some great memories, though. When I first got started, you know, our major developers were pretty much local guys, right?
Yeah.
It was Gary Brooks and Greg Simmons and Dick Tannenbaum and Mike and Scott Case. And, you know, I'm sure I'm leaving somebody out. But, you know, they're pretty much local groups. And we had some out-of-state groups that began to kind of come in and build. But COVID is where we really saw the big jump, right? Now, for one thing for us in our markets, it's been a little bit of a beneficial thing for us, because what's happened with the cost of construction, it's almost impossible to make a new construction deal pencil with our rents. So you can't go build new, rent it for enough to justify the cost.
So it's helped your existing product.
It's helped the existing product. It's kept that pressure down from a supply standpoint, whereas comparatively, Dallas and Austin, I mean, they have overbuilt so much that there's tremendous stress in their market on new development. That's why they're having the negative rent growth. They've seen, you know, some developers in real trouble where people are coming in and buying it below replacement cost just to kind of get them off the debt. So in one way, it's been really good. Let me give you a comparison on that. I wish I had this chart with me, but I'll send it to you where you can see it. It's pretty fascinating. You can compare the difference between what it costs to own a house and what it costs to rent a house in Oklahoma City and nationwide. And the gap all the way up till COVID is just like this, right? There's this, it's more expensive to buy than it is to rent. When COVID hits, that gap goes like this. It just is exponential.
More expensive to own. Because the insurance costs went up. Repair costs went up.
Interest rates.
And interest rates,
Cost of construction.
Yeah.
I'll give you an example. Greg Simmons, who's one of my good friends and best clients, he kind of builds a second home. He's one of the largest home builders in Tulsa. Pre-COVID, he built this nice 3-bedroom, 1,500 square foot, nice house, $220 a door, right? That same house that he's building today is over $300,000. And that's from 2020 till now, right?
Yeah.
And we've seen the same thing in apartments. You know, we've seen, you know, third-party bids to come back on a garden-style walk-up deal at $200,000 a door.
Wow.
And I know for sure one of the first new construction deals I sold was for Greg Simmons, the Shores at K-Rock. He won't mind me sharing this, but he built that in the mid-2000s for less than $100,000 a door.
Did you really?
Yeah, now that's
it's
how much.
It's over double.
Yeah.
And sometimes triple.
Yeah, it's just crazy what's happened to construction cost.
So let's, on that same construction cost, so I'm the chairman of the Council for Bond Oversight for the state of Oklahoma. We're just a watchdog group appointed by either the governor or senator representative. And I see every indebtedness that comes through the state of Oklahoma. And part of that is through the OHFA, Oklahoma Housing Finance. And so I see these almost every, and we have a challenge with workforce housing or low income housing to really, I mean, we got a housing shortage here. We need more. So we're seeing more and more product that they're actually able to help structure those transactions to ensure we have affordable housing. It's shocking to me the dollar amount that we're seeing for new construction for workforce housing. I've seen them anywhere from $220 to $350 a door. Wow. And then with all the tax structure and stuff, they're still able to give about $1 to $1.20 rent and still make those deals work. They could only do that because of OFA.
Yeah.
And I'm shocked at these prices for new build.
Yeah, that does seem high, you know, for me. Of course, again, a lot of it depends on where it is, whether it's downtown
Sure,
or
sure,
whatever,
sure.
right?
Yeah.
But yeah,
The higher numbers are in the bigger metropolitan areas like Tulsa.
yeah.
If something comes in from Tahlequah, it's usually less or whatever, Lawton or something.
You know, I think that's one of the biggest challenges we face, Mark, and I don't know what, because I mean, you can't. We're not going to lower construction costs, right?
Mm-hmm.
So to build something new, the only way that I can even envision you do it is exactly what you're talking about. Some kind of support from either community citizens, you know, who want to help in that way, or government programs or something that we can do it, because construction costs are what they are.
Yeah. And it's not going to change, I don't think. It's not going to go down.
I don't think so either.
You know, one of the challenges I think we have in our marketplace, we have well in excess of $10 billion worth of construction going on. If you think about it, we just passed the stadium. That's $1 billion. We're in the middle of a MAPS, which is $1 billion. We just passed a $2.7 billion infrastructure bonds.
Yep.
And so that'll happen over the next 10 years. And then you've got everything happening around the new stadium for the soccer team. And then we just finished up on Okana. You've got Chickshaws down at Pauls Valley are going to build their huge hospital. You got the new county jail, not to mention everything happening. That's a lot of that's public.
Yes.
And then not to mention, then you get all to the private sector, which is probably $2 or $3 billion.
Competing with the same subcontractors, you're saying.
Yeah. So think about those. We don't have enough labor to handle it. So what happens? You got to bring that labor in. Costs are going to go up. All cost of materials are going to go up. I think that we're going to see over the next 3 or 4 years a huge increase, probably 20-30%, in addition to what we've already seen in construction costs.
Yeah.
It's going to be hard.
Yeah.
So then you get to the affordability. So in rent, it's typically 30 to 35% of your income can go to your housing, right?
Yeah. What most management companies will use to qualify somebody for rent is 3 times income.
Okay.
So if your rent's $1,000, you need to make 3.
Yeah.
From a mortgage standpoint, as a rule of thumb, it's typically 28% of your income.
Okay,
so if you're buying a house, it's typically 28.
So 28 to 33%.
Yep.
So now, so you have your median household income. So you look at that, and so what we need to do is continue to grow our economy through higher paying jobs to increase our median household income, so we can have more affordability. But that takes time. It takes time. So how do you feel of what's going to happen over the next 3 or 4 years?
Yeah, good question. I'm going to send you these charts as well.
Okay.
I will, because it's pretty fascinating, because we track this pretty hard. One of the things that really is attractive about nearly all of our markets is our cost of living is so much lower than the national average, and a lot of that is due to housing.
Okay.
So even though we have lower incomes, because our housing costs are so cheap, when you look at it, I just remember this one off the top of my head. The city of Edmond, the average median income is for households like $104,000, give or take. Okay, that the average that family in Edmond is spending on their housing is 21%.
Oh, good. Wow.
Now again, we're really unique just because we're such an affordable city.
Sure.
So I think that's one of the reasons we see some disposable income in our markets, where our taxes are still good, our income tax collect, all those kind of things, right? Because we have more disposable income.
Yeah.
That still doesn't mean there's not a real challenge, though, for the lower percentile who aren't making that money, right? Because that percentage is still going to be 40 or 50 or whatever.
Because you still have
but
that
when
same
you look
rental
at
cost,
exactly
housing costs. So if you're making 104, but if you're only making 50,
that's right.
Now, because
we're talking about averages here, right?
No, I get it.
So when you look at it on average, we look really, really good. When you look at it on a per case basis, you realize we have real challenges, just like everybody else.
Right.
We have real challenges.
Yeah.
And I know this is something that you've been heavily involved in. Obviously, I know Gary Brooks has a real heart for this, and there's a lot of really smart people that want to try to help figure this out and solve it.
Mm-hmm.
It's a really tough challenge to solve.
Yeah. No, it is. It is. So, Tim, give us a few hints on why you're so successful.
Oh my goodness!
Come on.
Well, I think you know what I think. You and I know each other well enough, and we've talked about this enough. I think our stories are a lot alike.
Yeah.
I have to credit my dad a lot. I mean, I will say this. I want to get your opinion on it, and then I'll finish, okay? I think hard work is a learned skill.
Oh, yeah. Mm-hmm.
You do?
Oh, 100%.
I think if anything my dad did, I learned how to work hard.
Mm-hmm.
I didn't know any different.
So what were some jobs that you had to do?
Oh my goodness! So my first job, like where I got paid from somebody other than family, was I was in the 7th grade at Marlowe, and after school I cleaned up an implement store. Like
What's an implement store?
Tools, tractors,
Okay, yeah,
supplies.
yeah. Okay, yeah.
We would go in afterwards and make sure all the stuff was on the shelves where it needed to be. We swept it, we dusted it. You know, we did all that.
What'd you get paid?
I think if I remember right, it was $1.25 an hour.
Nice.
Yeah, $1.25 an hour, and then I began mowing yards like every other male person in the world.
Did you have a paper
right?
route?
I did not have a paper route.
I did have a paper route.
I did not. I have to share this with you because you will really appreciate this. But so, in the summers when I was in high school, I had 3 jobs. I worked at Fort Sill. We had a
Down in Lawton?
Yeah, we had carpool. 4 of us that drove over there to Fort Sill and worked from like 7 to 3. You just worked straight through lunch. I came home and would mow a yard, and then I umpired baseball games at night.
No way.
Yeah, that's what.
No way.
Yeah, that's what you did, right?
Yeah,
you did that. I know you did.
Well, no, I did. I got up early and had a paper out.
Yeah.
And come home, mow lawn.
It's just what we did.
Yeah.
We didn't know any different, right? And so one of the yards I mowed was right across the street from our house. And I had mowed it, and I noticed when I was about halfway through that one of the wheels was cockeyed, was off balance. So when I cut it, it had that little, you know what I'm talking about, like a little bevel, bevel to it.
Oh yeah.
I mowed it, finished it, and I remember specifically that lady paid me $6 to mow her yard, and I could mow it like an hour and a half.
Mm-hmm.
So that was like way more money than I was making anywhere else, right? $6.
You're getting $1.50 over there.
Yeah.
Here you're getting $4.50.
Yeah. So I mowed that yard. I'm sitting down for dinner that night. My dad came home from work. He said, "Son, did you mow that yard today?" I said, "Yes, sir, I did." He said, "Well, you need to get back over there right now and mow it again." He said, "That looks," I'm not going to say exactly what he said, but he didn't think it looked very good. So it's like 7 o'clock at night.
Did you get paid again?
No, sir. Because I'd mowed it like the day before. My dad.
She didn't feel sorry for you and give you those $6?
I don't think she knew. I don't know. But yeah, I remember that. We owned rent houses, and I can remember crawling underneath houses and doing all the sewer work and stuff like that. So, but honestly, I wouldn't trade those memories and what I learned from my dad about that for anything. I know you feel the same way about your dad and his hard work.
100%.
Isn't that what a great legacy to leave your family, right?
Well, and I was fortunate. My dad did one thing his entire career. He worked for Sears Roebuck. He started as a janitor, working his way through college. And when he got out of college, he then got into this training program at Sears Roebuck and Company, and he retired from Sears at 60, and then got into politics at that point. But yeah.
But what a great story, right? And just about
great.
Perseverance and hard work,
oh, yeah.
And doing that. And so I think that, and then obviously good fortune and hard work together is a great combination. Mm-hmm. And I think for me too, God's providential timing of when I got into brokerage, it was right before the great financial crisis. Everybody would have said that's the stupidest thing you've ever done in your life, right?
It was the smartest thing.
It was the smartest thing on complete accident because I didn't have a clue what I was doing. Mm-hmm. But by I was able to sell a deal in 08 that made me enough money that I could survive it. And then basically every broker that was kind of doing this just quit. Because nothing was selling, there was no money to be made, and it just left this vacuum, Mark, that we just stepped right into.
Well,
right?
that again, another parallel you and I have, because I started in 1985, Penn Square Bank failed. Oil went down to $9.
Yeah.
There wasn't a soul in the real estate business.
Yeah.
So we learned how to persevere during difficult times, and it made us better brokers because we had to work, as opposed to some of these brokers out there are what Harrison Levy calls a highway broker. They stand out next to the highway and just wait for a deal to kind of hit them.
I had no idea how hard we were. I thought it was supposed to be that hard.
Yeah.
Right? And in 21 and 22, we laugh, and I'd laugh with Justin and Brandon and Ben and Ted and just say we were like taking drive-up orders at McDonald's.
Yeah, yeah.
Literally just waiting for the phone to ring and taking an order, you know. Well, but I think those are probably the things. And I want to add one thing to that too. I think one of the biggest challenges for any man that's type A achiever doing that, you know, I think our priorities are good. Sometimes when you're choosing between good and good, we make the wrong choice. And I think work-life balance is the hardest thing we deal with, and not just in brokerage, but probably a lot of jobs. And it's what I talk with my younger guys a lot about is, I know you're not going to be a good broker if you're not good at home, but I also know work-life balance doesn't mean you're at home 40 hours a week and you're working 40 hours. I mean, God intended this to work, right?
Yeah, he did. You're better at that than I am.
It's hard.
It is
so hard.
Especially in today's world. It's so demanding. You know, we would think that technology is our friend, and it is, but it's made it harder.
Because we're working 24/7, right?
Yeah. Right, yeah. So, Tim, it's been a pleasure.
Oh, man.
Really, I mean, you're somebody I respect, love being a partner with you, love the connection we've had over the years, and I love watching you, and I appreciate you here today, sharing your story and sharing how we move forward in life.
Well, I appreciate it. I can't tell you how fortunate I've been to have such great partners in our relationship with you, not just on the brokerage side, but so many deals that we've done together, and the respect and love is mutual, I promise you.
Great. Thank you, Tim.
Thank you.